Hello and welcome to this edition of The Market Lens. I'm Sam Rozzi, the manager of Due Diligence, and I'm joined here by Cliff Walsh, our Chief Investment Officer. If you haven't already, please check out our previous episodes available in Studio 454 or on YouTube. Today's News or Noise segment will highlight the recent disruption in the commodities markets. Most commodities have been ripping on the upside, caused by the economic reopening, inflation, a weak dollar, and the recent pipeline hacking. These all have contributed to hockey stick-like returns in commodity prices. This has investors concerned about a melt-up. Is this news or noise?
This is a tricky one because I think the concerns are overblown about lasting inflation, as we've discussed on a previous episode, and I believe the same about the recent surge in commodity prices. But it is creating such economic and financial market shifts that I think it's news. The move and our expectation of an unwinding later this year could hurt portfolios with significant exposure. I think the recent moves are due much more to financial speculation and short-term shortages than a long-term supply-demand imbalance that would lead to sustained price increases. In 2020, many firms cut capacity, reduced inventories, expecting a long recession. The faster rebound has meant shortages in lumber, corn, copper, etc. Some bottlenecks may lack quick fixes like semiconductors, but many others can and will be resolved.
We've specifically seen interesting moves in agriculture recently. Futures markets have been extremely active, and we're seeing large price increases in corn, soybeans, and sugar. What are you seeing there?
You're right. Last month we saw a record in open interest for ag commodity futures, north of $300 billion. Soybean prices are up 27% this year, corn's up 50%, sugar up 25%, and a whole host of others up double digits. Nobody's having any barbecues, so who's eating all the corn on the cob? Take a look at the ISM manufacturing PMI, and it'll show you 3 times as many commodities in short supply than just 6 months ago. As I stated when we discussed inflation a few episodes ago, this was expected, at least by us, as the economy reopened. But given the employment situation and overall expected economic activity, this seems pretty temporary. Fears of an extrapolation of the recent spike in inflation is creating massive speculation in the futures markets, which we think will ultimately unwind. That's not to say there won't be long-term demand for certain commodities, from cell phones and clean energy, copper, lithium, to name 2, but I'm not sure now is the time to speculate in those.
I think your experience as a buy-side materials analyst is pretty valuable for looking at the recent market movement. When comparing to the early 2000s boom and bust cycle in commodities, how does this stack up?
Yeah, I covered the industrial and material space. China was driving that boom. At one point in that cycle, China was buying half the world's cement production. They were in the midst of a super cycle that has since ended. When I look at China, it all supports my view of a temporary surge. Their demographic situation is likely to work against another super cycle of spending. The Chinese population is likely going to decline this year for the first time in 60 plus years, despite relaxing family planning policies in 2015 when families were only allowed 1 child. Even after allowing citizens to have more children, birth rates are declining. Meanwhile, the over 55 population is growing. This is not the same China that drove the economic boom 15 years ago. This is a temporary restocking that is coming up against short-term reopening constraints.
So what are your expectations moving forward?
I think the market is going to work itself out over the next few months. Producers are busy ramping up production, and if prices get any higher, I think you'll see consumer demand dip, taking prices with it just as supply increases. Not to mention the technicals are showing extreme overbought situations in the futures markets in many of the aforementioned commodities, so they are due for a pullback. The noise is always loudest at the top, and it's been pretty noisy lately. But it's still news because the reversions to the mean is going to be significant, in my view. I think it was pretty interesting to see the inflation data we saw last week and see the CRB metals index pull back 3%. Expectations are high and unlikely to be met.
Thank you for your color on commodities. Now let's zoom into a different topic and revisit the search for yields. In our first market lens, we discussed that there could be an inherent top on yields. We're still one of the higher yielding global bond providers, and the 10-year has stopped making new highs after hitting resistance around 1.75%. Where should investors look for higher yields in a yield-starved world?
Well, let me start by stating where investors should turn away from. I think avoiding losses is more important in the so-called high yield world than making a ton of money from dividends or clipping bond coupons. I would stay away from this area, the lowest credit quality area. Financial conditions are the easiest on record. It's driven speculation in the worst junk. The spreads between triple C's and B-rated yields are the tightest since 2007. Triple C's have outperformed long duration treasuries by 20% this year. From a bond perspective, we like municipals over corporate junk. We still like long duration. However, as I said when we first discussed this a few episodes ago, I would hardly argue its yield is attractive from an aggregate level. It's more relative to the other options given high yield spreads and other sovereign country yields. It's likely to receive a boost as inflation worries die down. Emerging market bonds are interesting, especially if we're right and inflation doesn't go bonkers. They should hold up really well. However, it's probably the riskiest area of what we've discussed so far, especially if the dollar is in the process of bottoming, but yields in the frontier markets are pretty high.
Thanks for your color on the fixed income markets. Many advisors have been turning to equities to find income. Where should investors look on the equity side?
I think MLPs continue to be interesting, although given the recent run, the pipeline hack has brought a lot of attention to the space. It might make sense to choose entry points a little more carefully and buy during some weakness. Like emerging markets, the dollar could have an impact here. Utility dividend yields look pretty good and are worthy of some additional research, but I would stay away from consumer staples and durables. Asset flows are likely to be negative there, even though it is a typically a sought-after area for yields. The yields there are twice the S&P rate. The sectors have lagged, but I still expect some underperformance there as the economy reopens and other areas get consumer dollars.
Thank you, Cliff. We will continue to keep close tabs on these areas. One thing I like to emphasize when speaking to our advisors is to focus on risk more so than yields. The most important thing when creating portfolios is to ensure that you're not taking too much or too little risk. Clients are always able to take distributions if they aren't able to meet their income targets. And there are pros and cons to that, but I always believe it's better than skewing the client's risk level by reaching into riskier, higher yielding segments of the market. Thank you to everyone who joined, and I hope this is letting you see 2020. We hope to see you next time.